Derivatives are contracts that derive their value from one or more underlying assets or benchmark. There are various types of derivatives, the most common being futures, forwards, options, and swaps. But like anything else, there are layers to this. The derivatives landscape is vast. In addition to forwards, futures, options, and swaps, there are various types of each. American versus European options, shout options, interest rate and volatility swaps, perpetual swaps, weather derivatives, insurance derivatives, and much, much more. In fact, there are even derivatives on derivatives. Don't worry, we're not going there quite yet. We'll start by talking about futures. Futures are legally binding derivative contracts that obligate parties to buy or sell an asset at a predetermined future date and price. The buyer must purchase or the seller must sell the underlying asset at the set price, regardless of what the current market price is at the expiration date. If the future is cash settled, instead of the asset changing hands, both scenarios we'll be discussing in this video, the monetary difference between trade and settlement price is exchanged. Common contracts include crude oil futures, corn futures, euro dollar futures, equity index futures, and futures on currency pairs, or FX futures. There are four key components to any futures contract. It's important to note that for ease of universal comprehension and to facilitate trading on a futures exchange, these components are standardized by contract type. 1. Contract size. A futures contract has a standardized size that does not change, but it can be different for each product. As an example, one contract of crude oil represents 1,000 barrels, while one contract of gold futures represents 100 troy ounces. 2. Contract value, aka the contract's notional value. Contract value is simply calculated by multiplying the size of the contract by the current price. 3. Tick size. A tick is the minimum price increment for which a specific contract can trade. Tick sizes and values vary from contract to contract, but again, are standardized. 4. Delivery. Futures contracts have expiration dates and are either financially settled or physically settled at expiration. Now, this is fairly simple, but let's go over what that means. Physical delivery. The physical delivery method of settling commodities involves the literal physical delivery of the underlying asset on the settlement date of the contract. The physical delivery settlement process is coordinated and settled via a clearing broker or clearing agent. If the contract holder opts to take a short position, they're responsible for physical delivery of the commodity. If the holder opts to take a long position, they will be taking or receiving physical delivery of that commodity. Financially settled, aka cash settlement. This method doesn't involve the physical delivery of the asset under consideration. Instead, it involves the settlement of net cash, which is the difference between the spot price and the futures price of the underlying on the settlement date. The purchaser or the contract holder pays the net cash amount on the settlement date and execute the commodity settlement. Cash settlement is the more popular settlement method for cryptocurrency futures because of the convenience and instantaneity the method offers. More broadly, because of its popularity, many financial derivatives, such as options and futures contracts, are cash settled. Cash settlement is the more simple and convenient mode of settlement for obvious reasons. It only involves the upfront net cash amount as the total cost. Settlement transactions don't come with additional costs or fees. Cash settlement is also one of the primary reasons for the increased entry of speculators in the derivatives market. Consequently, this has amplified the liquidity of the derivatives market, making it a more sought-after mode of settlement. Let's talk about the types of parties that most commonly use futures contracts and why. The first group of traders are natural buyers and sellers, or hedgers. This includes parties such as oil companies, precious metal miners, insurance companies, or multinational companies. Each of these various players have their own motivation for buying and selling futures. First, let's take a deeper look when it comes to commodities. Some corporations that are producers or consumers of commodities use futures to reduce the risk that an unfavorable price movement in the underlying asset will result in the corporation having to face unexpected expenses or losses in the future. For example, this could be, say, a grain processor that wants to hedge, otherwise known as protect, against the prospect of a severe summer drought that could send corn and soybean prices soaring. Or it could be an airline that uses oil futures as a way of mitigating business and financial risks associated with an unprecedented change in oil prices. But futures contract use cases for these entities go far beyond commodities. Among other assets, a lot of futures market activity revolves around currency markets and interest rate markets. For instance, multinational companies that have revenues in multiple currencies across the globe play this same role in FX markets. FX futures can be used as a way to protect the business's profit margin on products and services sold at fixed prices from market volatility associated with exposure to secondary currencies. This could also be insurance companies who need to manage the duration risk of their portfolio. They play a similar role in the interest rate market. Now, let's cover the second group. Speculators such as big banks, hedge funds, and individuals who trade for a living alongside retail traders. Put simply, speculators aim to make money. Just like in the equities markets, speculators hope to capitalize on price fluctuations of the futures contract, ideally turning profits on price movements. Investors are able to speculate on the direction of a security, commodity, or financial instrument, either long or short, using leverage. Both types of participants play an essential role in generating the necessary liquidity for properly functioning futures markets. They provide ample numbers of willing sellers for willing buyers, a similar principle that applies in stock and bond markets. Well, that's all for this edition of Learn with Hxro Intro to Futures. We'll be back with more information on futures soon. So be sure to follow along and drop any questions or comments you have in the chat. Trade responsibly.